Hello, everyone. I'm Ted Oakley, managing partner here at Oxbow, and I always have the great pleasure of interviewing Dr. Lacy Hunt. Lacy is not only a friend of mine, but he's as good as you can get in knowing his area of expertise. Lacy he's the executive vice president and a chief economist for Hoisington Management, and they've been right on the money for a lot of years. And so I really have a lot of appreciation for what he does. I might say there's a disclaimer here, but it's basically to say that Lacy is not selling anything. He's not advertising anything. He's not trying to get you to do anything. It's just this is all educational and what they're thinking about certain subjects. So with that, we're going to move on, Lacy. And by the way, I wanted to mention to you, I thought your last letter was one of the best ever about cycles, and I think that's how you're going to start out today. But it was really good.
Well, thank you. You know, I'm talking about financial cycles. It's a term you don't hear very often.
No, you don't.
And I first started working with that concept with my book it was published in 1976 called Dynamics of Forecasting Financial Cycles. And I don't know how often the term is used. I think I may have was the first to employ it, at least in terms of developing it from an econometric standpoint.
And Lacy, I might ask you something because I hadn't been in the business long, but I was in the business in '77, and I believe you're in the beginning. You were negative on rates there for 4 or 5 years or so, some period of time.
I was indeed. You have a good memory.
Yeah.
In fact, I ran the commingled fixed income fund at the Fidelity Bank in Philadelphia. And I think for the entire time that I was there, I think we had probably the best 1.35 in 6 years, 7 years that you had for any commingled bank fund, fixed income. And was fortunate enough to see the inflationary problem develop and stay with it. And then I very fortunately became positive there in the fall of 1981 when the rates peaked. How I did that, I'm not exactly sure, but that was my attitude, and so I've been on both sides of this coin.
And gave you a lot of insight into what's going on today.
Well, thank you.
So on the cycles, you're all over this financial and business cycle, and it's an interesting concept.
Well, people think of the business cycle as being a single entity. That's not the way I look at it. I think that there are 3 cycles intersecting sine waves, which is the first graph. The first one, which is depicted by the black line, is the financial cycle. And notice that the black dot, which is the peak in the financial cycle, peaks ahead of the blue dot, which is the peak in the GDP cycle, and the blue dot peaks ahead of the price labor cycle, which lags. And the financial cycle is really determined by the looseness of monetary policy. And I would say that there are essentially a handful of factors that determine how loose monetary policy is. The first is the rate of growth in money supply, which in this cycle was a record. That's never before happened in modern times. Another consideration is the increase in debt, or if you want to look at it the other way around, the increase in credit. Another consideration is, of course, the level of real interest rates. And this cycle is also unique because the real interest rates were held at virtually all-time lows for a prolonged period of time. And the fourth consideration is, and it reflects the other 3 factors, and that is the degree to which both the financial institutions and the non-financial institutions are encouraged to take excessive risks. The looser the monetary policy, the greater the risk taking. And since the early 2000s, we have a fifth factor that determines the peak of the financial cycle, and that's forward guidance, where the Fed gives the market an indication of what their view is. And in this particular case, even in late 21, with inflation busting out of its seams, the Fed was still saying the guidance was lower, easier for longer. And the trough of the cycle reflects the tightness of monetary policy. And so you just flip this around. The other thing that we need to be aware of is that if you look at the black dot and the blue dot, the lead time between the black and the blue ranges from about 5 to 8 quarters. And the peak in the financial cycle occurred probably at the beginning of the fourth quarter of 2021. So we've already declined. We've come off the peak for 5 quarters. This quarter will be 6. And so we're in the range. But the range is variable. I wish I could tell you it was smooth. It's not. There are a whole lot of factors at work. The gap between the blue dot and the red dot, however, is much shorter. From the peak in the GDP cycle to the peak in the price labor cycle, we're only talking 1 to 2 quarters. So when the GDP goes down, very shortly thereafter, you'll see the price and labor market indicators move precipitously downward. Now, let's look at the red upward sloping line. That's the trend rate of growth in real per capita GDP. We've basically held it constant. And the research shows, and I'm going to share it with everyone, is that monetary policy, even when they push the financial cycle to one extreme, it's not altering the slope of the standard of living. It's basically not able to affect things for the better. All it does is basically add to the volatility. In other words, it can give you a boost, you move above it for a while, but then 2 bad things happen. Extremely loose monetary policy spawns inflation, and it spawns excessive risk-taking, which then set in motion a whole set of negative things. The majority of our people don't prosper in inflation. Only a very select few do. And so the central bank has to try to contain the inflation. And they also have to reverse the excessive risk-taking. And that's exactly what happened in the current cycle. The Federal Reserve had an extremely loose policy, and it gave us an inflation rate of 9% for a while. Their target was 2%, but there was also a lot of risk-taking. The inflation rate is starting to come down for reasons that I'll explain to you.
Lacy, did fiscal policy double up on it?
It was a combination of monetary and fiscal policy working together,
right?
Which is really problematic. The Federal Reserve Act was designed for the Federal Reserve to be independent of fiscal authority. And we have 2 great examples of where they combined. One was in 1971 in President Nixon's new economic program, and Arthur Burns was at the Fed. Nixon closed the gold window, took some stimulative fiscal measures. They instituted wage and price controls. And Arthur Burns' Federal Reserve revved up the rate of growth in money supply. And in what was probably one of the most egregious mistakes of all time, Arthur Burns, chairman of the Federal Reserve, agreed to serve as part of the wage and price controls. He was chairman of the interest and dividend control. So he had a tremendous conflict of interest. And when the new economic program of Nixon blew up in inflation, the fiscal policy partners were no longer there, and the whole cleanup job was left to the Federal Reserve. And the same thing happened with the pandemic. It was a coordinated monetary and fiscal policy. Would not advocate it. In fact, the Fed was supposed to be independent. When it blew up into higher inflation, the fiscal policy partners were not there. In fact, they went the other way, and all the cleanup job fell on the Fed's shoulders. And so this is one of the problems when you institute these theories of grand design that have never been tested before. There's no way to anticipate all of the negative consequences. And so it basically blew up in our face. And it had very devastating impact on probably the standard of living of about 180 million of us, which is a huge group of people. Before I finish with chart number one, I want you to look in the lower right-hand corner, in which I show the trend rate of growth from 1870, which is where our data starts, which is about 2.3% per annum. The black line is the actual rate of per capita GDP. And you'll notice what's happened. We've started falling below the trend line. And what's causing that is the fact that we're becoming extremely over-indebted. And the indebtedness is cutting into the growth. People have said for years that the extreme indebtedness would lead to a crisis. In other words, we'd have a very dramatic event, some sort of blow-off. But what the debt does is it's death by slow strangulation. It just grinds the economy down. And so the extreme over-indebtedness is pulling the trend rate of growth below the historical average. And I'll have something more to say about that in a minute. Let's go to the next chart, chart number 2. And I'm going to look at several great economic thinkers who basically use this concept of financial cycle, even though they didn't use the term. And I can trace the work back to the great David Hume in 1752. The late economist Ingrid Reimer said that the Enlightenment could not have happened without David Hume. He was one of the most brilliant minds of mankind. He was a complete man. He knew all the fields. Albert Einstein said that it was after reading Hume on time and space that he was inspired to the theory of relativity. This is how keen Hume's concepts were. In 1752, he wrote these 2 towering papers. One is called Of Money and the other is Of Public Credit. And at Hume's time, they were operating under the gold standard. So the monetary effects were described in terms of a gold inflow, gold outflow. And Hume noticed that when you had a trade surplus, gold would flow into the country, which would presumably be a good thing. Economic activity would heat up, and so would the inflation rate. And what would happen is you would lose your trade surplus, gold would flow out of the country. And so the gold inflow, which was the central bank or the equivalent, you would get a boom and then you would get a bust, but you'd end up back where you started. You weren't any better. And the other great paper that he wrote was called Of Public Credit. And he looked at all of these great examples of extreme over-indebtedness that up until the time that he wrote the paper, he looked at Rome and Mesopotamia, which basically collapsed under debt, as well as other less well-known examples. And his famous phrase is that when you become so top-heavy with debt, the result is tranquility, languor, and impotence. Languor, of course, is a word that we derive languishing from.
Lacy, I don't know this, but it's a question for you. But have throughout history, have most countries that got so indebted, it took them down eventually?
Yes, and usually it's a bad outcome. There are 4 the great economic historian Neil Ferguson, who's now at Hoover Institute, was previously at Harvard, wrote a book, The Ascent of Money. And Neil Ferguson looked at four great empires, the two that Hume looked at, plus the Bourbons of France and the British Empire. And the Bourbons basically drowned in debt. That's what destroyed their economy. And part of that debt that they incurred was funding the American Revolution. There were more French troops at Yorktown than American continental soldiers, and it was the French fleet that blocked the British evacuation from Yorktown. And the other great example was the British Empire at the end of World War II. Now, people will say, well, Britain survived. Yes, Britain did survive, but there, as Winston Churchill famously said, the sun never sets on the British Empire. They lost the empire, but Britain survived. Basically, when World War II ended, Britain had to continue rationing. They had to jettison India and Pakistan because they simply couldn't continue to raise the funds. But there are a lot of other smaller examples, but it does not end well. But it doesn't necessarily end in catastrophe. It can just be a withering away, as in the case of the British Empire. It was disastrous for Rome, Mesopotamia, and the Bourbons. But it's not a good outcome. You become so weak. And one of the things that Hume did at the end of his paper, he said that to prevent this, what government should do is they should always run budget surpluses, so that when you have some sort of national catastrophe, you have the funds to pay for it. In other words, you don't want to be in an enfeebled financial condition when the great challenge comes.
We always call it a death by 1,000 cuts.
That is a better phrase. Death by 1,000 cuts. I'll have to steal that concept. The next great economic thinker there in paragraph 2 was the Swedish economist Knut Wicksell. His name's constantly mispronounced. A great thinker. And basically what he said is that you'll have stable economic growth if the Fed keeps the market rate of interest in line with the natural rate of interest. And the natural rate of interest is the rate of growth in nominal GDP. If the central bank is dissatisfied with the natural rate and they accelerate monetary growth, you get a transitory boom, but then it blames inflation. And what does the Federal Reserve or the central bank have to do? It has to then bring the natural rate below. The market rate below the natural rate. In other words, it imparts volatility, but it doesn't make you any better, which was the same conclusion that Hume had. In paragraph 3, we come to Irving Fisher. Fisher had believed prior to the Great Depression that the economies were purely cyclical. He didn't dwell on these secular forces, the financial cycle per se, and over-indebtedness, and he missed seeing it. In 1933, he wrote his Mea Culpa, which is an outstanding article, the first issue of Econometrica. And he lists all of the cyclical factors of recession that people talk about all the time: excessive accumulation of excess capacity, overbuilding of inventories, decline in real income, so forth. He listed, I think, 30 or so different cyclical factors. But he said that all of those too pale in comparison to the two overriding ones, and it's overaccumulation of debt and the ensuing deflation. We don't have the term disinflation in it. For him, deflation could be either a slowing in the rate of increase in prices or an outright decline. Then we jump to my book in 1976, which was comprised of 60 stochastic equations, first large-scale econometric model of the financial markets. And I estimated my variables over the period from the early 1950s to the early 1970s. Started writing the book in 74, was published in 76. And what I found is that, and this is really critical because I'm going to prove it to you that it still holds right now, is that the operations of the central bank first reduce the rate of growth in bank liabilities. In other words, bank deposits. That's money. And then after you get a reduction in the liability side of the bank balance sheet, then the asset side comes along, but its liabilities lead assets. And right now we've got a unprecedented decline in deposits, and we're already getting some decline in the bank asset side. Then we come to paragraph 5, Hyman Minsky, who wrote in 1976. So that meant that when I wrote my book in 76, I did not have benefit of Minsky. That came a year later. And Minsky said that debt accumulation leads to financial instability, which is an important concept, but Minsky is incomplete. He did not attach the over accumulation of debt to central bank actions. And so what I would do is I would amend Minsky, and I would say that extreme looseness in monetary policy leads to over accumulation of debt and financial instability and the famous Minsky moment. In other words, I would rewrite Minsky.
Well, that's what we always hear on the Minsky moment, that there is a spot where you can't make it happen anymore.
That is correct. And then you come to 1978, which is Charles Kindleberger. Kindleberger was better than any of them, including me. He thought that a lot of the excesses resulted from monetary actions. I think that what the research shows since his book in 1978 is that the majority of the problems, overwhelming majority, come from monetary action. And so I would rewrite Minsky just a little bit and say that extreme looseness in monetary policy leads to manias, panics, and crises, which is the title of his famous 1978 book. Let's go to the next page and look at the scholarly work that was done from 2005 to 2022. In paragraph 8, Dr. Rajan, who was a former governor of the Reserve Bank of India and Booth School of the University of Chicago, a brilliant economist, and the conclusion of his great study, which was presented at Jackson Hole in 2005, is that when interest rates are relatively loose, financial intermediaries have incentives or even required to search for yield and risk. And the search for yield in turn increases financial risk. Paragraph 9, I'm quoting Robert Barrow and Jose Ursula at Harvard. They did an extensive study of macroeconomic crises over a large and broad, diverse group of countries from 1870. And the reason this study is important is that they find that when you get into these microeconomic crises, it's not a single event. It's multiple events. It's a process. And so we've already seen, 3 major banks fail, but all occurring very quickly. And if you go back to 2008, you'll remember, first of all, it was Washington Mutual that fell, and then it was IndyMac, and then Wachovia Bank, great bank, had to be merged. And then it eventually led to Lehman. But this is never a one-event deal, is what they're saying. And when you go to one extreme, it's a process of working out of it. And then in paragraph 11, Drechsler, Savoy, and Schnabel, they find a theoretical link between lower interest rates and increasing leverage, and thus risk taking. In paragraph 12, Study done by Liam, Ma, and Wang. They find that individuals starting in a high interest rate environment will tend to make riskier investment decisions when you push them to a lower interest rate environment. And then in the next paragraph, we find additional confirmation of this view. Now I want to take you to the next page, which was a very important study that was published this year. It's called Loose Monetary Policy and Financial Instability. The writers are Grimm, Jorda, Skularic, and Taylor. Taylor is perhaps the most well-known. These men are extremely skilled, and it took a lot of different skills and the database that was developed over a long period of time to be able to separate the financial conditions from the real conditions. And in paragraph 15, I want to read their key findings. A loose stance of monetary policy has potential benefits as well as costs. Loose financial conditions and extreme increased risk-taking may not be a bad thing per se. They might, for example, enhance consumption smoothing by relaxing financial constraints or raise innovation and efficiency by providing more investment capital. However, our historical evidence suggests that running such a high-pressure economy may not be sustainable in general. In following, we argue that potential short-term gains come at considerable cost in the form of heightened risk of disasters in real economic activity. In other words, you go extremely loose. There could be some benefits, but the majority of the benefits. And so then what this does is that it forces the central bank then to take even more extraordinary steps. And so they perpetuate one financial cycle into another financial cycle. So let's see how we're doing. Let's go to the next chart. What you're looking at here is the rate of growth in M2 against ODL, other deposit liabilities, which is the main deposit component. M2 is different from ODL in that M2 includes currency and money market mutual funds. Currency is a medium of exchange. It's a store of value. It's a unit of account. It certainly it is money, but its influence and importance is diminishing. You cannot use currency for big transactions. It's too cumbersome. And a lot of folks just don't want currency anymore. They're risk of it, particularly smaller and medium-sized businesses, but even hotel chains now don't take currency for any services other than tipping, and then you're dealing with individuals. So currency is still money, but its importance is diminishing, and the money market mutual funds are merely a pass-through entity. Friedman never believed they belonged in there, and so ODL is the most moneyness concept. It can be used. It does most of the transactions, is most of the store of value. So look at the chart, and I always adjust for inflation because this is critical. We had 2 years in which ODL averaged better than 20% rate of growth, nothing like it going back to the early 50s. And now we have a record monetary contraction. Let's look at the next chart.
And Lacy, I was going to ask you on that chart. That is an amazing chart. If you look at almost a 75-year history and how much they juiced this thing with that free money, basically, it's really interesting. Great chart.
And don't forget your point that you asked me about earlier. They had the lethal combination of tying it to federal expenditures. And so there was a coordination of monetary and fiscal policy that was working there. The money numbers by themselves don't really capture. So let's turn to the next chart, and let's look at bank credit, which would be bank assets, would be securities and loans. And I think you're going to find this chart very, very interesting. Bank credit really is more of a late cycle variable. It's it's really normally doesn't turn down until after the GDP is already turned in. And let's look at that. Let's go to the recession of 1960. And you'll notice that, and I've got the 1 year and the 2 year growth rate. The 1 year doesn't go negative until you're already in the recession. And then go to the recessions of 1970, same thing. Doesn't go negative, doesn't cross the zero line. If you go to the recession of 73, 75, you're halfway through that recession before bank credit goes negative. And then go to the recession of 1990. Bank credit doesn't really go negative until you're in the recession. The 2000 recession, bank credit was a very mild recession. Bank credit doesn't even go negative. But look at the great financial crisis. Very telling point. Bank credit does not go negative, just barely goes negative until you're out of the recession. It's a late cycle phenomenon. But look at the latest numbers. Both the 1 and 2 year rate of growth in bank credit in inflation adjusted terms is negative. We're not in a recession. GDP has not yet turned down. But the banks are contracting the flow of credit to their customers. Now, look in the upper right-hand corner. Historically, bank credit after inflation grows 3.4%. And the 1 year rate of growth is negative at a 2.3% annual rate. Let's take it one step further. Let's look at the 3 year rate of growth because now we're going to pick up that huge money mountain of 2020 and 2021 and see whether, in fact, the Fed has neutralized it. Let's go to the next chart. And what do you see? ODL and bank credit have both hit the zero line. And that's the month of April. And I can tell you that when we see that we have 10 days in May already, and in nominal terms, both ODL and bank credit are declining, even before the adjustment for inflation.
And Lacy, I might ask you, does that mean since it's so early that it's going to be a lot worse?
That's a possibility. That's a distinct possibility. And so...
because you predicted this 9 months ago. You said at the end of the first quarter, that's when we're going to start seeing all that.
And by the end of the first quarter, I felt that they would have neutralized the money mountain of 2020 and 2021. People say, well, where is the recession? There's no recession. Well, it's not supposed to be here yet. So the point is that we have erased the increase, but you don't expect the relationships to change much out of their historical pattern. And so we've erased that money mountain in basically 5 to 6 quarters, but the lag with the GDP cycle is in the range of 5 to 8. So there's a lot of restraint coming through the pipeline. Let's go to the next chart. We have to take into consideration the velocity of money. And on this chart, chart number 8, you're looking at ODL velocity. There's been a bit of an upturn. It's important to understand that velocity is still very depressed. It's a lagging indicator. Remember the formula, it's your money variable times velocity equals GDP. GDP is a coincident indicator. Money's leading, which means velocity is lagging. So this upturn in velocity here is one of the reasons why there's a lag. The private sector tries to find ways to offset the monetary restraint, but that's a very limited gain. But once we move further along here, velocity will turn down, and there's a couple of reasons why I believe that will happen, which I'll explain as we go forward. But because velocity is determined by those two variables in the left-hand corner, the marginal revenue product of debt and the loan-to-deposit ratio. The marginal revenue product of debt is going to go lower because a lot of debt was taken on when interest rates were extremely low in 2020 and 2021. $10 trillion of debt matures this year, another similar amount in 2024. When you have to increase the allocation of the stream of income to interest expense, that is the least productive use of the income stream. It doesn't build a new factory or hire a new worker.
I think my numbers are right on this, Lacy. I know you know, but if you look at total debt between at the end of 19 and the end of 20, call it, there was about a $10 trillion increase in total debt, 54 trillion or something like 65. But there was only a real GDP was only up 790 billion.
That is correct.
And
very poor return on our money.
Have you ever seen a more illustration of not knowing what you're doing than that one?
Well, it's the problem that you always encounter when you adopt a theory of grand design. There was a very famous sociologist by the name of Robert K. Merton. He was considered the father of modern sociology. He was the son of the Nobel laureate who teaches at MIT, who's also Robert Merton. Merton it gave us the law of unanticipated consequences, but he gave us the fallacy of the theory of grand design, and he used this example of a fellow who's out hiking and he sees a cave on the side of the mountain. He's interested in caves, and so he walks into the cave, and the path appears to be clear. So he walks further into the cave, and the path is still clear, and he ventures until he comes to the blockage. And he says, well, this is easy. I'll just reverse myself and walk out. But what the caver doesn't know is that by walking into the cave, he caused the cave slide. In other words, the pathway out is not the pathway in. And so Merton said that basically it's a fallacy to adopt policies that you've never tried before because you cannot possibly anticipate the consequences, and therefore it's better to operate and use the theory of the middle range. In other words, you have to do experimentation, but you make it relatively small so that if the thing fails, you can reverse it.
Mm-hmm.
But unfortunately, in this particular case, they went so far that they were not able to easily reverse it, in part because fiscal policy was no longer a partner. And then we're left with the overhang that we're now trying to work our way through. So let's go to the next chart. This is the longer term chart of velocity. Goes back to 1900, upturn, basically at a very low level. Let's move to the next chart. This is your first major determinant of velocity, the marginal revenue product of debt. Notice there from the early 50s to the early 80s, we were generating about 70 to 75 cents of GDP growth for every dollar of debt. Now we're at under 40 cents, and we're going to convert a lot of this debt at higher cost because it was taken on at the low rates of 20 and 2021, which tells me that velocity will turn down as we go forward. This is a transitory gain in velocity. It's complicating the Federal Reserve's efforts now, but when velocity turns back up, everybody's heard the term pushing on a string.
Mm-hmm.
And we know that coming out of recessions, but in this particular case, pushing on the string is not going to describe the limited capabilities of monetary policy. Let's go to the next chart. This is the other critical determinant of velocity. It's the loan to deposit ratio at the banks. The red dots are where the loan to deposit ratio is at the start of the recession. The blue dots is the cyclical trough. Notice that the loan to deposit ratio reaches its low on average 47 months after its peak, in part because bank credit's a lagging economic indicator. So look at what's happened this year. The loan to deposit ratio has gone up from 60% to 70%. But when the loan demand turns down, which it appears to be doing, started the last 4 or 5 weeks, the nominal increase in loans is very muted. Inflation adjusted terms is declining. The loan to deposit ratio is going to turn down, and that will then reinforce the decline in the marginal revenue product of debt, and velocity, although it's rising now, may rise again for another quarter or two. It's going to turn down and complicate the Fed's ability to bring the economy back. Now, one of the things that people say to me is, well, you've given a lot of documentation of monetary restraint, but yet the labor markets are holding firm. But the point of the first chart was to show that the price and labor market data is the caboose. The financial cycle is the engine. Now, if you look at the employment measures, the labor markets appear to be holding firm. But the chart that you're looking at here, the productivity of our critical non-farm business sector, is in the tank. We've had the 2 largest consecutive yearly declines in productivity since the series was created in the 1940s. Now, productivity is output per worker. Now, when you see productivity declining like that and hiring going on, it basically means that firms are overstaffed. And they basically, in order to bring their unit labor costs, which are currently running 6%, the core inflation rate is now down to 4.6, but unit labor costs are at 6. To get a major reversal downward, the business firms cannot continue taking the hit to their profitability. And if you look at the macro profits, I'm not going to debate this business of what the company profits are. I don't follow them. But the macro profits have shown a major corporate profits recession over the last 6 months. And it has to be the case with this type of decline in productivity. So the firms went through a difficult period when labor was not available. The same thing happened in 1974. That was the first time that we heard the term labor hoarding. We'd gone through the wage and price controls. Labor was in short supply. Firms were not willing to let their workers go, and they took the hit to profitability because they expected the recovery to come back quickly. So what will happen is that when the firms can no longer take the hit to profitability, they will rationalize their labor force. Productivity will rebound. This will put pressure on the labor markets, but it will also reduce unit labor costs, and we'll see the deterioration in the labor markets occurring at the same time that the inflation rate makes the next leg downward. Let's go to the next chart. This is another contraindicator that the labor markets are strong. We've have an unemployment rate at a 6 or 7 decade low, but firms are not willing to pay up. This is your real weekly average hourly earnings. And we had back-to-back declines of 2% in 21 and 22. And we further declined in the first quarter of this year. So in the last 9 quarters, the average weekly income, weekly earnings of 180, represents 180 million people, 120 million people, have suffered nearly a 5% loss in their standard of living. Now, we know that retired folks do not do as well as working folks. We have 72 million retirees. The Social Security Administration tells us that only 11% of those 65 years or older have other income than their Social Security check, which means that the high inflation has basically clobbered 180 million people. And that's why the Federal Reserve basically had to correct the inflation. You can't let the economy run hot. There are not enough people that do well in this type of environment. And these numbers really don't reflect the hardship for the modest and moderate income households, because the inflation is centered in shelter, food, and fuel. Now, these are what we call price inelastic goods. They don't have good substitutes. But shelter, food, and fuel the percentage of the modest and moderate income households is very high. Ted, in your income bracket, those basic necessities are a very modest component of your budget. But that hurts the family, the households that we're counting on to deliver this economy and move it forward. They've suffered a very, very heavy blow.
I spend a lot of time talking to people just on the street, all the time. Since I sort of grew up, I grew up that way. I know what to ask them, and it's interesting. They're having a tough time.
They are.
They are.
And that's one of the consequences. See, inflation robs everyone, but it robs the modest and moderate income households the most. It's really devastating to them. And so that's where we are. But if the situation in the labor markets were truly as resilient as it seems, productivity would be not declining 2%, but rising 2%, and the firms would be willing to increase real wages, and they're not.
And ironically, that's what the Fed has their eye on, the very thing you're talking about, and it's lagging. Interesting.
It's lagging. It's at the end of it's the tail end. Okay, so if we look at broader measures of income, this is total household income, includes wages, salaries, interest income, dividend income, proprietor's income. We had the two big bumps, which reflected the fiscal monetary coordination. We went above trend, but now we've fallen below trend. And that's unfortunate where it's hitting the worst. And then one of the consequences of that is that we're now seeing an upturn in delinquencies. That's on page number 15. There are 5 different measures of delinquencies. The 30-day are now moving up pretty sharply for all of them. Let's look at the 90-day rates. They're also now all moving upward, which is an indication that the pressure on a lot of our folks is resulting in a later payment. And I'm afraid that those numbers are going to get worse. And that's one of the reasons why, according to the senior bank officers lending survey, the banks are tightening their lending standards quite significantly. But the New York Fed indicated that there was a very sharp increase in the first quarter versus a year ago in the consumer installment loans. It's really very consistent with this data. Let's go to the next chart. Now I want to look at fiscal policy because it's a factor too. What you're looking at here is gross federal debt as a percentage GDP, 5-year average. We have to look at gross federal debt rather than net. Net, you're kidding yourself. Yes, there are funds in the trust department and the trust accounts, but the assets that the trust accounts like Social Security and Medicare have are very small in comparison with the unfunded liabilities. So you have to, and moreover, you cannot compare net figures between one country and the next because they're all different. But the gross is similar.
That was interesting, Lacy, because it looked to me like when you wrote that book in 1977, it was 35%, roughly.
Yeah, 35. Yeah.
Wow.
And now the latest 5-year is at 120. But look at the dot there. This is the deleterious impact point from an article that was published in one of the American Economic Review publications. The authors were Carmen and Vincent Reinhardt and Ken Rogoff. This study, unlike the book, this time is different, was peer reviewed. There's no Excel spreadsheet error. The data here is clean. By the way, the Excel spreadsheet that was made in the book, published 2 years earlier, it was an error, but it was really not consequential for the finding. But we hit that dot in 2013. So let's go to the next page and look at the conclusions of RR&R. And they looked at 26 historical major debt overhang episodes, 22 advanced economies, and their standard here is that the ratio must be 90% for 5 years or more. because they want to eliminate just the cyclical upturns in debt, normal business cycle stuff. And they also want to eliminate the war years. And look at their first major conclusion. The economic growth rate is reduced slightly by more than a third compared to when the debt metric is not met. That was their finding. Let's take it further. So let's look at the situation in some of our major foreign competitors. So France, 5 years at an all-time high, not quite as low as we are in the US. Italy's worse. Japan is approaching 220%, almost 100 points higher than in the US. So what we would expect is, if the Reinhardt and Rogoff findings are correct, we should be falling below the trend line, and Europe and Japan should be falling below our trend. And then I'm going to show you that that's happening. So on page number 20, the blue line is the long-term trend from 1870 to 1977. It was 2.3. There's your RRR inflection point. So we started falling below it before we got to 90%, which was a possibility that was allowed for. Notice where we were when the pandemic hit. We were $10,000 below trend. In other words, the black line was $10,580 less. And now, after $10 trillion of stimulus, unprecedented, the real per capita income is $12,766 below. 60,000 versus 73. Major difference. But the point that I'm making is that Reinhardt and Rogoff said that we would lose a third. What you're looking at is the loss of a third. In other words, this is more than a decade outside their sample period. The historical experience since their publication was signed off has actually been confirmed by the actual results. So this takes us to the comparison with Europe and Japan. The red line is the rate of real per capita GDP in the US relative to Europe, and it's plotted on the right-hand axis. And the black line is the per capita income in Japan relative to the US, and we set it equal at $2,010 in the foreign currency markets. So everything's been accounted for. Have the currency factor out of it. Same series for both the U.S. and for Japan, Europe, and Europe. It starts in 1995, which is the first time we have data for Europe. So notice on the black line, in 1999, Japan actually has a higher standard of living than we do by 7%. And the U.S. is 18% higher than in Europe. Now, looking off the latest plots, we are 17% greater than Japan. So we've switched from 7% less to 17% greater, and we've gone from 18% above Europe to 26% higher. So, in other words, not only is the Reinhardt and Rogoff estimation holding for the U.S., the implied result for Europe and Japan is also confirmed. Which takes me to the last chart, which is sort of captures a number of things that I'm interested in, which is the volume of world trade. This is obtained from the Dutch Bureau of Policy Analysis. Let's look at the chart. This is the year-over-year change. Notice that in the recession of 2000, we don't go negative until we're already in the recession. Notice that we don't go negative until we're well into the great financial crisis of 08-09. Before the pandemic hit, we'd gone slightly negative. Remember, there'd been a major monetary down cycle of Fed tightening in 2018. ODL M2 had come down. The yield curve had almost inverted. And we might have had a recession had it not been for the pandemic. But look what has happened. The volume of world trade is now negative. We're not in a recession. globally. But world trade has turned down. This is one of your high multiplier sectors. But I think that the numbers are worse based on some anecdotal information for April. You can look at the volume of inflows into the California ports and outflows of merchandise. And if you look at the 12-month moving average, which is what you have to do because the data is not seasonally adjusted, the incoming goods are now 2.5% below a year ago. The outcoming goods are down only 0.4%. So we're cutting the demand more against the rest of the world than they are. And that's in part because last year there was a major appreciation in the dollar, which is helping.
You know, Lacy, if you look at, I know you know this, but you look at dry bulk and freight rates and freight loads, all of those are in a declining mode.
It's a very interesting dichotomy. The consumer appears to be holding firm. The retail sales have been good so far this year. But for all of the freight measures, the ones you mentioned, if you look at the Cass Freight Index, it's down 4 consecutive months, down 6 of the last 7 months. If you look at the air freight volumes, the rail, the intermodal, the Long Beach ports, overnight they reported the Taiwanese trade data for April showed a major contraction in April. And I think that when China reopened and they eliminated the COVID restrictions, it was well known that China would get a bounce in the first quarter. But the Chinese economy is one of the most over-leveraged economies, and it appears that their bounce is already playing out. Mm-hmm. But one of my professors said to me many years ago, the rule you follow here is they don't ship what they don't sell. And so the shipping volumes are down, but the sales here continue to be high. So the rail freight numbers are giving us the same sort of story as the income numbers of the household sector.
So Lacy, for the consumer that really collected all that money, extra money during 2021, do you think they're about run out of that?
I think that's what the 3-year number for ODL and M2 show.
Okay.
That the money mountain has been used up. And it was used up by 2 factors. First of all, the Fed has reduced ODL by about $1.5 trillion when they tighten monetary policy and they sell the securities out of their portfolio. What they're doing is they have a giant vacuum cleaner on that money mountain. And so it comes in the vacuum cleaner and goes into the incinerator. So I don't like to use this term, but because but they were printing money and now they're burning money.
Yeah. And so you think if you look at the latest credit card numbers, so they've switched over to using credit debt.
Yeah, they have. And I think, and they're not keeping current with their bills either.
Right.
Which is a telltale sign. So I think we're in an interlude here when the economy appears on the surface to be okay, the consumer appears to be okay, but the internal fundamentals are worsening very significantly.
So if you had to, I know it'd be just an estimate, but Lacy, if you had to guess, somewhere over the next 6 months, 12 months, some time frame, it all has to come together in a more negative way, it looks like to us. But how do you feel about that?
I feel strongly. I think that we're going to go into a recession. And I'm afraid what will happen is that we will make the situation in Europe and Japan worse than in China because they're overly dependent on us. In fact, when the pandemic hit, there were several problems for the world. Number one, we were massively over indebted. We kept trying to solve every major problem by taking on more debt. So we were really in a debt trap. Another problem is that growth was falling below trend for so long that the demographics were weakening around the world. The demographics are getting worse. The United States demographics have deteriorated, particularly the household formation and also the birth rate. Um, and in Europe and in Japan and China, the figures are even worse than here. And I'm one who believes that demographics are destiny. I think you need young populations. You need family formation. Those family formation is or household formation is very expensive, but it's a stimulant to economic activity. Think of what forming households and having children costs. Think of the cost to the overall economy, not just to the household, but the businesses supply them, the state and local governments that have to provide schools and so forth. And another element in the picture here is that the demographics are negative overall, but on the East and West Coast and parts of the upper Midwest, the demographics are horrible. There's an article in today's Wall Street Journal which indicates that New York City lost almost 500,000 people, 5.5% since 2009. And although the numbers in San Francisco are not nearly as big, the percentage loss is 7.5%. That's today's Wall Street Journal.
Yeah.
And so you're leaving tremendous holes in parts of the economy, but you keep the states that have the positive demographics, they're less affected by the business cycle.
So, Lacy, one last question to you. I think most people, including us, would feel fairly certain that the debt limit obviously would be extended because it's politically, they couldn't stomach it any other way. But don't you find it interesting that all these politicians have no concept of just to borrow, and to look at 32, 33 trillion in debt or whatever? It just seems that they have no concept of what that does in the long run at all. I mean, that doesn't even seem to register with them. And, if you're on a personal basis, you were doing that, you'd have to file bankruptcy.
Mm-hmm. There's two things, I think. First of all, neo-Keynesian economics advocated the proposition that it was different if industrialized governments went into debt than if it was an individual, a household, or business. And what the research shows, very sophisticated research, is that the point that you made is that in the final analysis, there is no difference between what happens on the individual business level and the individual house. If you get over indebted, bad things happen. And the same thing happens at the governmental level. Now, another part of the problem is that those that were concerned about debt felt that the impact would be some sort of explosion or major crisis, rather than your term, debt by 1,000 cuts. In other words, that the problem is not really that visible to our people. In other words, they don't understand that we had a trend line at 2.3, and now we're deviating below that trend line. And in fact, the people of high debt will say, "Well, you promised a debt explosion, and where is it? It hasn't happened." And I said, "Well, that's not what I promised. I felt that that's not what David Hume promised. He said the result was languor, tranquility, languor, and impotence. It's you fade below, you get weaker and weaker." I totally agree with your assessment. The fact of the matter is, the Social Security recipients and the veterans benefits, and these are going to have to be paid. And we go through this dance every so often. But it seems to me that they will reach an agreement because they have to. And I think that a very positive step is that the negotiations now are strictly between the Speaker of the House and the President. This is what was done in 2013 after the Obama administration lost Congress. They made a negotiation with John Boehner. Boehner was the seat of power. And so and the seat of the one party is the administration. The seat of power for the other party is the Speaker of the House. So basically, the two seats of power have to negotiate the deal. Everybody else is now no longer participating. And what will happen is that when the administration and the Speaker of the House have an agreement, the rest are going to they have to either accept it or vote against it, but it will pass.
Right.
Because the Republicans will follow the Speaker of the House. They're not going to repudiate the deal he made. And the majority of the Democrats will not repudiate their incumbent president. And so the negotiations are at a fairly more serious and focused point when the extraneous parties to the deal are no longer in the negotiation. And so I think that progress will be made, and we can't go very far into it because we're not going to upset the retired folks and the veterans and a lot of other people.
Well, Lacy, listen, I want to thank you as always, and I would always say to people that I think you and the Hoisington Management Group has one of the best letters every quarter that I certainly ever read. And I would recommend to people sometime to look at your resume. If you look at your career resume, I really don't know anybody that's ever had the experience around money and the system and the Federal Reserve and the banks and everything that you have. It's really an incredible career resume. I want to commend you on that.
Thank you.
But listen, thanks so much.
I feel very, very blessed that I'm in the 54th year of my career. I sometimes can hardly imagine that 54 years have passed. You're a very good friend, Ted. Thank you.
Yeah, a lot of knowledge there for sure. Well, Lacy, we hope to have you back next year if you'll go back up. So thanks a lot.
All the best.
All right. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.